We are exploring the world of tax credits. So Christine and I have been asked to provide some basic information of the myriad of tax credits, federal, state, payroll that are out there. We're going to focus on a few of the federal credits, business and individual, and then mainly Virginia tax credits is going to take a big chunk of that. That's an area we really haven't explored a lot. So we wanted to dig in there and just see what's out there in the world of Virginia tax credits. So the basics of tax credits. We're going to start just with a brief explanation. Hopefully everybody's worked with tax credits, but we may have some new people who have not. So tax credits, they're a dollar for dollar reduction of the income tax you owe. They're generally better than just an ordinary tax deduction. So if you have the option between taking a deduction and a credit, majority of the time the credit would be the better option. They're available generally to offset your income tax, your franchise tax, payroll taxes as well. And so, of course, we're going to look at some federal ones, Virginia, payroll. Many other states also have various tax credits, and sometimes even localities have various tax credits, but, you know, something to, you know, look out for. So we're going to start out with the federal tax credits, and Christine's going to get us started with the employee retention tax credit, and then we're going to discuss the worker opportunity tax credit and a little bit on research and development tax credits. I know they talked about some changes in the first session today on research and development expenses and all, but we're just going to focus on the tax credits and the federal, Virginia, and the payroll, and then opportunity zones, which really aren't a credit, but a lot of people kind of put them in that bucket, and do a little bit of that reminder before year end. So take it away, Christine.
Okay, welcome to everyone. So if you're like me, we've been hearing an awful lot about the employee retention credit. So I'm hoping that a lot of this will just be information that everyone's familiar with, but hopefully we've got it all in one place, and we're going to touch on a couple of latest developments related to it. So the employee retention credit is available for the period from March 13th, 2020 through September 30th, 2021. When we get to the end of this section, I'll talk a little bit more about that end date and what that means going forward. It's based on qualified wages and health insurance paid during these periods. It's available to nearly all non-governmental organizations. It is subject to certain limitations. And the claim for the credit is done on the quarterly Form 941, or at this point, it will be on an amended Form 941X. That 941X, if you go that route, is going to be due within 3 years of the original due date of the return. So for example, a 2020 quarter 2 941 that you want to amend would then be due 2023 on July 31st. So we can go to the next slide. And we're going to talk a little bit about the eligibility requirements. So to keep the slide a little bit easier to look at, I didn't break out the extra requirements for 2020. So to briefly touch on those, at the start of the credit for 2020, you had to have significant decline in gross receipts of more than 50% compared to that same calendar quarter in 2019. Now that changed to a 20% test in 2021 as compared to the 50% that we started with in 2020. The eligibility continues until your gross receipts decrease below that 20% mark. In general, that eligibility is going to continue through the calendar quarter that you fall below that test, and then you would no longer qualify the following test. So in essence, that means once you have qualified in a current quarter, you would automatically qualify for that immediately, the next immediate quarter. So the other eligibility requirement, if you do not meet the gross receipts test, would be the full or partial suspension test. That one's a little trickier, definitely more subject to interpretation. So we have been basing it, when possible, on the gross receipts test, where it's a very clear answer. The full or partial, hold on a second, Kendra, could you go back to the prior slide? The full or partial suspension test, as written, it is the operation of the trade or business is fully or partially suspended due to orders from an appropriate government authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes. So as you can imagine, obviously there is room for interpretation in there, and the dates that those government orders are in effect are going to further complicate when and how you can take the credits over those periods. Okay, now we can jump to the next one, and this just throws the details up there for the 2020 calculations. So in 2020, we were working on a single $10,000 wage base for the entire period from March 13th through December 31st. So that credit was 50% up to $10,000 in wages and healthcare costs for each employee. And the total credit was limited to $5,000 per individual for 2020. The 2021 calculation is more favorable, of course. As David mentioned this morning, that one now has us up to 70% of that 10,000 qualified wage and healthcare base. That wage base is based on each quarter. So that'll be Q1, Q2, and Q3 of 2021, which ultimately results in a credit up to $21,000 per employee. So we've got some incredibly high dollar amounts that can amount to over the course of these couple of years. So if we jump to the next slide, that talks a little bit more about qualified wages. So they are defined differently for a large employer, which is one with 100 or more employees in 2019 versus a small employer, which would be 100 employees or fewer. At its most basic definition, the wages for the large employers are limited to wages for employees that are not actively providing services. So they're paid, but they're not actually working due to circumstances relating in one of those full or partial shutdowns. The total wage base is reduced by wage amounts that are used for calculations of other forms of assistance. That's going to be loans, grants, credits. Examples I've listed here are the PPP loan forgiveness, COVID sick and family leave pay, which also ended during 2021. When you get into the nonprofit arena in particular, there's a lot of grants that are going to be used and applied against that wage base as well. So you're going to want to, in most cases, back that out as well. Obviously, the IRS does not want us double dipping on those wages in order to give us the credit. So wages paid to owners are also unlikely to qualify for this credit. This is going to include all owners that are at 50% or more ownership. That does include attribution rules. At the end of the day, it basically comes down to if you are an owner and you have any living relative, you are likely not going to qualify for the credit if your ownership is at 50% or more. As a firm in general, we have been excluding owner compensation in order to avoid any questions that may be questionable as far as exactly how we're calculating that, or if we're unaware of what the family situations are and who may be involved. I would like to point out that that was a change made during 2021. And it was a retroactive change. So when the guidance came out, that had not been clear before that was the intention. So there is the possibility that you may have filed for an ERC for 2020 that did include that owner's compensation. So in that case, your best practice would be to file an amended 941X in order to remove that owner's compensation from your credit base. The last piece of that overall wage base is the health coverage. That is going to be health coverage paid by an employer during the period. It's eligible to the extent it is not included in employee compensation or as an after-tax deduction. So basically, if you are paying your health coverage to your employees in the form of a reimbursement, that would not qualify. QSERA plans do not qualify typically, and the after-tax deduction is going to affect that total amount also. Otherwise, you are able to just take the full amount for the employer paid amount. I would like to point out that since the credit is based on an employee wage base, each individual employee, you do need to have the employer split out the cost for each individual person rather than a lump amount for the company. Okay, so just a couple other things I want to mention before I get into the termination of the credit and how that may affect us going forward. One is that refunds tend to be delayed, in some cases very delayed, especially if you are filing a 941X in order to receive your employee retention credit. The 941X has to be filed on paper, which, as you imagine, adds to the backlog and slows down the entire process. I want to point out to everyone here that many companies are also receiving notices from the IRS because they have applied for the ERC for a prior period, and then they use that rollover amount on their next quarterly filing. And the IRS doesn't have that first one in their system, especially if you're doing it through a 941X, an amended filing to begin with. So the IRS is aware that this is an issue. In most cases, it's going to clear itself out, but I realize that can cause a lot of headaches and a lot of concerns for clients. So feel free to come talk to me, ask me any questions if you have an issue related to that, but also let your clients know that this is it's a known problem and it's something that they're working their way through. The credit amount, as far as how it is applied on your books from a bookkeeping level, that's basically going to result in a decrease in your payroll expenses. And especially in the case of a 941X filing, you're going to need to record a receivable on your books for that. And I already mentioned at this point, we're filing Form 941X to amend the credit. So you have 3 years from that original due date in order to file that form. So back to the termination of the credit. So that's effective 9/30/2021 with the infrastructure bill. There is an exception for recovery startup businesses, which are new businesses starting during the pandemic. And the potential issues that we can fall under now is that some companies have already received a refund in some form or another for the fourth quarter ERC. So there's 2 ways you may have gone about doing that if that applies to a client. The first would have been a filing of Form 7200. That is the advance payment that you can request from the IRS for that. So if you filed Form 7200 for Q4 of 2021, that advance that you expect to receive or have received needs to be repaid by the due date of the employment tax return. So generally that's going to be January 31st of 2022. If the employer instead reduced payroll tax deposits in anticipation of the fourth quarter ERC, the full amount that you short paid so far or reduced your payments by so far must be paid in full by December 20th of 2021 in order to avoid penalties. So that gets us all up to date to current on the employee retention credit. Does anyone have any questions on that before I move on? Okay, so with that, we have your first CPE attendance code, and that is credits. I'll give you a moment to jot that down before we move on to the next. Code word again is credits. Okay, so the work opportunity tax credit. This can be claimed for an employer that hires and pays or incurs wages to certain individuals who are certified by a designated local agency. Usually that's going to be your state workforce agency. And they need to be certified by that agency as being a member of a specific targeted group. So the individual must be in their first year of employment. Please note that employees that have worked there before but now meet those and have been rehired do not qualify for this credit. The individual should perform at least 400 hours of service for the employer during the year. There is a reduced credit available for those who perform between 120 and 400 hours. As mentioned, they need to be certified as being in that targeted group as well. So this slide shows who is a member of a targeted group. Couple to point out is veterans. They actually have a slightly different credit rate, as you'll see in a second. Formerly incarcerated, if the individual or some of their family members perhaps are receiving state assistance under the Social Security Act, they may qualify there. They're living in an empowerment zone or a rural renewal area. And individuals experiencing long-term unemployment, I believe that that is considered 12 months or more of unemployment. Obviously, they need to be actively looking for work over the course of that 12 months. Okay, so how much does this credit amount to? It's going to be 40% of up to $6,000 in wages paid to the qualifying individual. So that would be a maximum credit of $2,400 typically. So you can use a wage base of $24,000 for a qualified veteran. So obviously that results in an increased credit. And as I mentioned on one of the prior slides, if they work less than 400 hours, but more than 120, then you can actually qualify for a 25% credit rather than the 40%. As with the ERC, wages cannot be used to calculate other wage-based credits as well. So you can use that employee for multiple credits, but obviously not. That $6,000 cannot also be used for the ERC, PPP loan forgiveness, anything else. And then to claim the credit, this is the biggest downfall here is that you have to plan ahead. In order to claim this credit, you have to get certification immediately after hire. Basically, you have 28 days from that new hire start date to submit this form 8850 to the designated local agency. They are the one that will then certify whether or not they fall into one of those targeted groups. Once you have received that, then you can file form 5884, 5884C in the case of a tax exempt employer when you file your income taxes. And that wraps up the work opportunity tax credit. Any questions on that one? Okay, Kendra, I think we're back to you for a bit.
Okay, so I'm going to talk about research and development tax credits next, but I'm curious. I forgot to throw out a question. How many tax credits do you think there are for 2021? Anybody got a guess? No guess? Well, if you Google it, it comes up, there's 53 tax deductions. And yep, y'all are way under. 53 tax deductions or credits. But the other Google answer is there's really only 3 tax credits: non-refundable, refundable, or partially refundable. So there's a lot out there. So anyhow, we're only going to cover a few of them. So research and development is going to be our next one. The purpose for the research and development credits, they're available for qualified expenditures related to research and development of a new or improved business component. Generally, it's some kind of product, process, or technique that you're working on, or software. We see that we're seeing this more and more in other industries as well. So it's not always just in like the biotech or the manufacturing or the software industries. Research must involve a technical uncertainty, and generally the 3 main expenditures used for the tax credits are based on your wages for employees who are involved directly in the research and development, supplies, and then contract research as well. So what's the credits? The credits, the research and development credits have 3 ways to do it. They have a regular credit that's 20%. There's a reduced credit you can file for that's 15.8%, or there's also what they call an alternative simplified credit that's a flat 14%. They all have different reasonings why you might take one versus the other as to reducing your expenses by the amounts. Normally that's why you do the simplified credit, so you don't have to make adjustments to your deductions. But if you wanted to claim the R&D credit in a year and missed it, you aren't eligible for the simplified credit. So sometimes you're going to be required to take a credit, larger credit, the larger credit. So these are generally claimed against the individual and corporate income taxes and are generally non-refundable. Taxpayers must reduce their deductible expenditures by the amount allowable, unless, like I said, they use the alternative credit. So how do you claim the credits? So for partnerships, S Corps, and C Corps, they generally file the Form 6765, credit for increasing research activities. That gets filed with their tax return. And then pass-through entities, also they'll file the Form 3800, the general business credit form, and that's a form that kind of compiles all of your credits into one place, and the individuals will kind of pick it up on their returns as well in that place. So the interesting thing about the R&D credits is there is a payroll tax credit election that can be made annually by qualified small businesses. A qualified small business is a corporation, S Corp, or partnership that has gross receipts of less than $5 million for the tax year, and no gross receipts for any of the tax years before that 5 years. So it's basically you're a brand new startup. You aren't receiving any revenue yet. You're all in the initial phases, so you can use the credit to offset those payroll taxes, which is really nice. Cannot exceed $250,000, and the election has to be made on or before the due date of the originally filed return, including your extension date, and it's made at the entity level. So the corporation would make it at its level, and then and that election is also made on the 6765. You cannot make the credit if you've already made it for 5 or more preceding years. So again, there's just that 5-year time frame. The credit is claimed against the employer's portion of Social Security tax on their 941 for the first quarter that begins after it files the return reflecting the payroll tax election. So we have a couple of C Corps we do this on. And so if we don't file their return until October 15th, they cannot claim that credit until the first quarter of the next year. So it's following it after the return's been filed. When you file your 941s, you'd complete a Form 8974 to include the amount of the the R&D credits that you're applying to cover your employer payroll taxes. And you'd attach that form with the 941 when you file it. And David had mentioned in the first session, you know, we've had a few issues with that. I mean, obviously, if our firm is doing the payroll, we can handle this no problem. We've run into issues with, you know, whether it be QuickBooks or ADP or some of the payroll providers that are out there don't want to really mess with it. And so we've had some clients fully eligible, but were not able to take it and kind of lost out on the whole credit, not knowing that in hindsight. So just want to be careful that you're coordinating the deductions with the payroll provider if you want to take advantage of this. So now we'll do the second attendance code word. It's going to be incentives. Incentives. All right. Any questions on the R&D credit? I know it's very brief, but as far as filing and how to do it, well, it's definitely an option of like I said, more and more industries are using it and it's available. So you definitely want to kind of bring that up with clients and inquire about what they're doing, whether it's farming or, you know, manufacturing or anything, because it may pop up where it might be advantageous. Next, we're going to talk about just the opportunity zones. So the purpose of the opportunity zones was to provide some significant tax incentives in various opportunity zones that they kind of set up throughout the U.S. They're generally designated in low-income communities, and the purpose is really to just spur long-term investment in the low-income areas to generate opportunities for startup businesses, jobs for individuals in those areas. So it's definitely been somewhat new. It started in, I guess 2018 was the first year it came out. So it's still relatively new. So something to be on the lookout for. So any taxpayer that realizes eligible gain with an unrelated person can make an election to defer the gain. Taxpayers include individuals, corporations, partnerships, and S corps. And trust and estates too. I haven't seen any on trust or estates, but I've seen some entities as well as mainly individuals making these elections. So if a partnership or S corp realizes the eligible gain, it has a choice that it can elect to defer that gain at the entity level, or if it chooses not to, it can just pass that gain on to the individual owners, and then they are eligible to make that election themselves. So what is it? It's eligible gain can be deferred if the investment in the qualified opportunity fund is made within 180 days of the date of the sale or exchange or the date of gain recognition. During COVID, they kind of had extended some of these dates, but for now, we're kind of back to operating under the normal 180-day rule. Short-term, long-term capital gains, 1250, 1231, and installment sales, all of those qualify for deferral. The opportunity to defer gain recognition is a benefit. So you have a gain this year, you defer that gain, and you have to recognize it in 12/31/2026, or if you get out of that investment earlier, you would recognize it at an inclusion event. It's the second opportunity is the permanent tax reduction. So the longer you're in these investments, there's kind of a step up in basis. So if the investment is held for 5 years, there's an increase in basis by 10%. And 12/31/21 would be that 5 year. So if you have clients who might have gain this year and want to try to benefit as much as they can now from the permanent tax reduction, they would need to invest in a QOF by the end of this year. So that's, again, just something planning. If you have clients who have large gains, they still may be able to get that done. I've had some right on 12/31, moving the paperwork and stuff around last minute, but it can happen. So, and there are a lot of them out there. So something to talk to your clients about. The investments that were held for 7 years, they have an additional 5%. So if they put in by 12/31/19, they'll get a full 15% increase in basis. So, you know, if it's a $100,000 gain, you're deferring 15,000 of that would be a step up, and you'd only pay gain on the 85,000 in 2026 when it's required to be recognized at that point. One of the bigger benefits is even if you don't meet the 5 or 7 year time frame, you get an increase in your basis to fair market value if the qualifying investment has been held more than 10 years. So basically, if you recognize your, $100,000 gain on 2026, if that investment goes up to 200,000 in the future and you held it for 10 years, you would not recognize gain at any point in the future on that additional appreciation. So that's definitely an added benefit. So how do you claim it? You usually elect to defer the eligible gain on the 8949, reporting the total gains for the year as a positive number and then backing that out as a negative adjustment. And the 8949 has kind of the instructions to walk you through it all, but it's pretty easy way to make the elections, and then you just track it. So from the entity level, they would track file a form 8996. That's basically to report that the QOF meets their investment standard, and there are penalties if you fail to meet some of these standards. So that's kind of what that form at the QOF level would file. And then if you're an individual or at the investor level, you would file 8997 each year to kind of report your investments and any changes if you have new QOFs or if you dispose of a QOF. So that's the way the IRS is trying to track this. So I think that's the end of my session. So any questions on opportunity zones? No? All right, if not, we'll turn it back over to Christine.
Okay, hello again. So I am going to briefly cover the individual tax credits. So there's a lot out there, not a lot of changes. So some of this is just going to give you a list of what's out there, and then I'm going to go into a few details on some other ones. So the individual tax credits available fall into a couple different buckets here: the family independent credits, income and savings, homeowner, healthcare, and education credits. So we'll start with the family independent credits. And these are the ones that are most affected with changes for 2021. So the first three: the child tax credit, recovery rebate credit, earned income tax credit. These all sound familiar, I think, if you were in the first session this morning. Followed by the child independent care credit, the adoption credit, and the credit for elderly or disabled. So the child tax credit, as David or Helene, I don't remember which now, I mentioned this morning, there were some changes to that here in 2021. So advance payments began in July 2021. They were typically meant to be sent on the 15th of each month, so clients should have received them mid-month for July through December, unless someone opted out of the program. It wasn't real easy to opt out of, so I think a lot of people got them whether they wanted them or not. So the credit is $3,000 for each child, age 6 through 17. And as they mentioned this morning, through 17 is a bit of a change. Before it had stopped when they hit 17. It's increased to $3,600 for each child, age 0 through 5. The payment received was an advance on the 2021 credit based on that 2020 filing. So there is the possibility that some people may need to repay some of those advance payments if that 2021 credit is actually calculated to be below the payment amount. So those advance payments were meant to be, they were calculated to be about half of what the anticipated credit would be. So where you may have a situation where you need to repay something is if, for example, you had a child that you claim one year and you don't claim the next year. So if you're no longer going to be claiming that child and are no longer eligible to take that child tax credit, then you'll have to pay back any advance payments that you received. If somebody has aged out, in theory, the IRS should have picked up on that, but that's another option where you may end up receiving a little bit more than you should have. So we'll go next to the recovery rebate credit. So the third economic impact payment was sent in early 2021. I believe that was in March, although based on when people filed their tax returns, that could have happened anywhere or been adjusted from March up through December. That amount would have been $1,400 for each taxpayer and dependent, and that would include children up to that age 17. The payment received again was an advance on the 2021 credit based on your 2020 filing information. However, that one, no repayment is necessary if the 2021 credit is calculated to be less than the amount that you already received. So for both of those, the recovery rebate credit payment, that third economic impact payment, and also on those advanced child tax credit payments, you have the option as a taxpayer to go out and actually look at the IRS website in order to see what you received. They will have record of what was sent to you. Obviously, they can't account for what happened in the mail, but that'll at least give us base information for that. So if we are working on a client's tax return and they are unaware of whether or not they received those credits, they should be directed to go look on the IRS website in order to get that information. So next we'll touch on the child and dependent care credit. This credit was increased to up to $4,000 for one qualifying person or $8,000 for two or more qualifying persons. In that case, the expense base was increased to $8,000 for one, $16,000 for two or more, with the maximum credit being 50% of expenses. They also mentioned this morning there is a phase out of that credit from 50% of those expenses down to no credit at all for taxpayers with the AGIs between 125 and 438,000. So at 438,000, you have now phased out completely, and that credit is not available. And the 2021 credit is refundable even if it exceeds your tax liability. So before I go into income and savings credits, any questions on those family independent credits? Anything jump out at anyone? Wonderful. Seeing nothing, I'll go on. And the rest of these are really just more a list for your knowledge of what's out there rather than going into too much detail. So under the income and savings credits, we have the Savers credit, which was the retirement savings contributions, foreign tax credit, excess Social Security and RRTA tax withheld, credit for tax on undistributed capital gain, and credit for prior year minimum tax. Next are the homeowner credits. And that is going to be the residential energy efficient property credit and plug-in electric driver vehicle credit. Healthcare credits include the premium tax credit and the health coverage tax credit. And lastly, education credits. There's the American Opportunity Credit and the Lifetime Learning Credit. The majority of those really have not had a lot of changes in the last few years, which is why I haven't gone into any additional detail on those, but I wanted to make sure everyone was aware of what was out there. So if there are not any questions, that wraps up the federal piece and obviously the individual tax credits. And sends it back to Kendra.
All right, so we're gonna talk about the Virginia tax credits now. There are individual tax credits, farming and agricultural credits, environmental credits, business, research, development, and investment credits. There's bulk of them under housing, community development, rehabilitation tax credits, port and international tax credits, and then, lumped in all where else is the miscellaneous. So some of these are pretty obscure credits for very industry focused, very industry focused. So the first one we'll do is the individual tax credits, and didn't really dig in here. I mean, there are some low income tax individual credits that you file on your Schedule ADJ. And then obviously everybody's familiar with filing credits for taxes paid to another state when you're doing your 760. So there's not as many tax credits. There's more deductions maybe on the Virginia side of things. And I'm not sure if there were any others that Christine had as part of her session to add. But pop in if there's any I'm missing there on that.
Yeah, nothing to add on the individual side for Virginia.
Okay, great. So I didn't spend a lot of time on that. I did look at the farm and agriculture credits. So again, I kind of head up our agricultural team here and work with a lot of the wineries and vineyards. So this is an area where I've done a few. So they have the agricultural best management practices credit. New is this conservation, tillage, and precision agricultural equipment credit. Both of those first two are refundable credits. The farm wineries and vineyards tax credit, that's one we file often for some of our wineries and vineyards. Food crop donation tax credit is available, and then a Riparian Waterway buffer credit. And that's, I learned way more than I needed to know probably in agriculture today on this. So while we're here, let's do our third code word, agriculture. Agriculture. All right, so the purpose of the agricultural best management practice credit is to provide improvement to the water quality in Virginia streams, rivers, and bays. Farmers, growers, and ranchers engaged in agricultural production for market or have an approved soil conservation plan qualify. The credit is equal to 25% of the first 100,000 spent for approved ABMP work when you have approved soil conservation plan in place, or it's 50% if you have acreage covered by an approved resource management plan. The aggregate amount cannot exceed $75,000, and it's claimed against the individual or corporate income taxes. It's a refundable credit, but you can't use the same expenses for both the 25% or the 50% credit. So normally where you see it, to claim the credit, you would file Form ABM by April 1st. They don't allow late applications, and generally you get a letter certifying the credit received by June 30th. Results in the need sometimes to extend your returns or amend them so that you can wait till a credit is received. And I think when you're claiming the credit, you're usually putting it on Schedule CR, 500 CR, or the 502. So again, a lot of times you'll just, if you're doing a individual return, you're seeing that letter come in from the farmer who's, done significant work and on their property to meet those requirements. So the next one is the Conservation, Tillage, and Precision Agricultural Equipment Credit. It's a refundable credit. This is a new credit, which really replaces two credits that were there before. So I don't know if it's new. It looks like it's more like a combined credit now. But farmers, growers, and ranchers engaged in agricultural production for market who have an approved soil conservation plan in place qualifies, or those that have a nutrient management plan developed by a certified nutrient management planner would qualify. And any farmers who purchase certain equipment designed to reduce soil compaction, disturbance, or to more precisely apply fertilizers or pesticides. So that's like your no-till drills, those types of things, your sprayers, your fertilizer applicators and stuff that they buy. So what is the credit? The income tax credit is 25% of the cost of the equipment. Again, sprayers, applicators, just general equipment that helps in that conservation effort. The equipment must meet the standards set by the Virginia Soil and Water Conservation Board. So, and the maximum credit is $17,500, and it can be claimed against individual or corporate income taxes. And it is a refundable credit. So you claim that by filing a Form AEC within 90 days before you file your return in order to get the letter that certifies the credit, and then you claim it on your individual returns or your business returns. Generally, that's kind of a constant thing. The next one, the Farm Wineries and Vineyards tax credit is to help offset costs for starting a new farm winery or vineyard, or it's also eligible for existing farm wineries. It's an income tax credit of equal to 25% of what you spend on qualified capital expenditures relating to starting or improving the farm winery or the vineyard. So the barrels, the bottling equipment, chemicals, the grapevines, all of that, poles and posts, work. Oh, hold on. Sorry, y'all. My thing went wild on me. So the credit cannot be greater than your tax liability. So it would carry forward any excess credit for 10 years. You cannot claim the credit for expenses you deducted as for 179 on your tax return. So normally you would just capitalize them and just depreciate them over the normal life. I think bonus is eligible. It's just the 179. So most farms aren't. A lot of the farms I work with don't have income, so they're not taking 179 anyhow. But that's one of the limitations there. And the credit can be claimed by both individuals and corporate taxes. And this one, again, like most of them, have a specific due date. So the FWV form is filed by April. They send you a letter to certify that you are approved by June 30th. They do look at what you send in with a list of like the qualifying equipment. And again, a lot of times we're extending the returns or amending them later if they want to take the credits. So with some of the credits, you'll notice that Virginia and the other states, they'll cap their credits. So they're only going to give away a certain amount of credits. So for this particular credit, they'll cap it at $250,000. So that's the purpose of the application period. Everybody who applies, the total applications are reviewed. And if the total amount on those applications exceed the $250,000, then they end up prorating the credit that eligible taxpayers can get. So sometimes, you might put in for a $50,000 tax credit, and when it's approved, you might come back and it might be $10,000 or $15,000. So sometimes it's as as much as maybe a third of what you originally qualified. You just don't know until the letter comes back. So another one is the food crop donation tax credit, and this is for farmers who donate crops to a nonprofit food bank in Virginia. I've not run into this before, but it is out there. The food bank has to use the donated crops in a way that provides food for the needy, and the donated crops cannot be used outside of Virginia and can't be used to pay for goods and services. Food bank sells the donated crops. They can only sell them to the needy, other nonprofit food banks, or other organizations that will use the crops to feed, to provide food to the needy. So it's an income tax credit of 30% of the fair market value of the crops donated. Total credit cannot exceed $5,000, and it can be carried forward for 5 years. Food banks that receive the donations, they initially fill out a FCD2 with Virginia. or for Virginia, and give it to you, whoever donated the property. Again, this one has a cap of 250,000, and so if you're the organization or individual who's donated this, you would then file a FCD1 by February 1st to claim the credit and get them to certify that before you can claim it on your tax return. So, Riparian Waterway Buffer Credit, this one, again, very unique, is landowners along Virginia rivers, streams, or Chesapeake Bay that harvest timber from and leave trees near the waterway standing. So that's what they call a riparian buffer. There must be a stewardship management plan certified by the state forester on your land. And if, you can get this credit, but if you break your stewardship plan, the credit would need to be repaid. So kind of details behind what administers what the buffer would be. It's 35 feet, but no more than 300 feet. And the Virginia Department of Forestry administers this credit. So there are a lot of different state agencies that get involved in the state credits that we run across. So what is it? It's an income tax credit equal to 25% of the value of timber in the buffer if the timber were harvested. Maximum amount of the credit is $17,500, and then you can carry forward any unused credit for 5 years, and both individuals or corporate income taxes can be reduced by this credit. So that's one that's out there. Any questions on either of those agricultural credits discussed? Y'all are a quiet group. Are y'all awake out there? I know we had lunch. And this is riveting stuff. So fourth code word, environmental. Environmental. All right, so that leads into our environmental credits, which are biodiesel fuels credit, green job creation tax credit. There's a recyclable materials processing equipment and alternative recycling credit. Vehicle emissions testing equipment, clean fuel vehicle and and certain refueling property credits. And there's a waste motor oil burning equipment credit and a land preservation tax credit. So lots of environmental credits out there to encourage just, going green and taking care of our environment. So the biodiesel fuel credit is eligible to any producers who make up to 2 million gallons of biodiesel or green diesel per year. The credit's only available during the first 3 years of production. Biodiesel is a fuel that's made from new and used vegetable oils or animal fats or similar materials meeting certain requirements. And green diesel is a fuel made from non-fossil renewable resources, including cultivated plants, trees, and their byproducts. I think I've only seen, we've looked into this credit for one client, but I haven't run into it before then. An income tax credit equal to 1 cent per gallon of fuel produced. The maximum credit's $5,000. You carry forward it for 3 years. This credit is transferable, which is interesting, and you can claim the credit for the year you complete the transfer. Now this one, the Virginia Department of Mines, Minerals, and Energy will certify that you met all the requirements to apply the credit, and I had not heard of this department before. So you'll complete the form BFC, attach it to your certification form from that department, and then file it with your returns. The green job creation credit, this one was kind of interesting. Again, I haven't seen it in application, but you qualify if you create a green job that pays an annual salary of at least $50,000. And a green job is one in an industry related to the alternative and renewable energy. So Again, kind of like worker opportunity credit, things like that, starting jobs in this area. It's a $500 income tax credit for each new green job that's created, and you claim the credit for up to 350 new jobs. You can claim the credit in the year you create the new job and for the next 4 years, so long as the job remains continuously filled. And the credit cannot exceed tax liabilities, so it can carry forward for 5 years if it's unused. And again, individuals and corporate taxes can be decreased. And again, as if with all the credits, there's a different form to claim it. So the form GJC, and that one is required to be filed 90 days before your income tax return is filed. And you do reapply every year to, that you have the eligible jobs there. There's another credit, again, this major business facility job tax credit, which I think is on slide in the future. So if you're claiming that, you can't do both for the same jobs. So recyclable materials processing, again, as it sounds, it's a credit that's you're eligible to qualify if you make things from recycled materials in Virginia, or you recycle waste products into raw materials others use to make things. So again, and it's interesting credit. Again, I have not worked with clients in this area, but it's a good credit to know about if you do work with people or know people in this industry. It's an income tax credit equal to 20% of the purchase price of equipment you buy to make things from recycled materials or to convert waste products into raw materials. And it's claimed in the year you buy the equipment, and the maximum amount of the credit cannot be more than 40% of your total liability. And carry forward is for 10 years for this credit. And they can issue no more than $2 million in recyclable materials credits. So again, the cap there. And you'll file with the Virginia Department of Environmental Quality, DEQ, and they certify that your equipment is integral to the recycling process. And once you've received that certification, you can file Form RMC by June 1st and to claim the credits on your tax return. All right, any questions on those? Okay, vehicle emissions, testing equipment, again, another credit on purchase of vehicles, testing equipment, and you're located or in or next to a locality that has an enhanced vehicle emissions inspection program in place. I did not dig to see where those are at in Virginia, but if anybody knows that, please share. So it's an income tax credit equal to 20% of the purchase or the lease price paid during the year for the qualifying vehicle emissions testing equipment. And you claim that credit just on your Schedule CR of your individual, corporate, or pass-through entity tax returns. You need to enclose a copy of your air check, Virginia State Participation Agreement, or a copy of a Northern Virginia Analyzer Equipment certification. So that goes with it. Another one related to vehicles or equipment, the waste motor oil burning equipment credit. Your business operates a facility in Virginia that accepts waste motor oil from the public. And it's a credit of 50% of the price paid for the equipment used to exclusively burn waste motor oil. Maximum credits at $5,000. Again, I have not seen this one before. I imagine there are places that are using it. Claim credit in the year you buy the equipment and on your individual corporate return. And again, this is another one that gets certified by DEQ and filed on your tax return. So nothing really there. Now, land preservation tax credits. This is tax credit you'd qualify for if you give or convey land or the right to use land or an easement to a public or private nonprofit group classified as 501c3 by the IRS. So we do see these more often. The gift has to be permanent. And the approved land uses are for historical or conservation purposes, agricultural use, forest use, open space, and natural resource conservation. So the land preservation credits, it's a income tax credit equal to 40% of the fair market value of the land at the time of the donation. And you have to have a qualified appraiser determine what that fair market value is. Depending upon the amount of the credit that you get or the donation you're giving, you may or may not need to include that appraisal as part of your tax documents and with your request for the tax credit. So Virginia tax will only issue up to $75 million in land preservation tax credits each year. They are issued on a first come, first served basis, and that seems like an awful lot. But in the early years when they used to have the land preservation credits, and you'd meet this limit sometimes as early as September or October. I don't think in the past few years it's, I think those who had land in Virginia and could benefit from it have probably given most of theirs. But I mean, you still see them. I probably have 1 or 2 clients a year I kind of run across myself. So I assume there's more in the firm, but it's a big limit there, I think. It used to be you could claim up to $100,000 per taxpayer. And so again, it was definitely more advantageous in years past. And for the last couple of years, they limited it to $20,000 per taxpayer. Still a good benefit, but not nearly as much to offset your Virginia tax liability. And how do you claim it? So there's an LPC-1 form that you file with its schedules and attachments, and the record of the deed of the donation, as well as a copy of the completed IRS Form 8283. The full appraisal is generally sent with this LPC-1 to the state, and a signed statement from the appraiser. Request over $1 million or more must be submitted to the Department of Conservation and Recreation. So again, the higher the donation and the credit, the more they really review it closely to make sure it meets all the requirements. You claim your LP tax credits by completing a Schedule CR and attaching it to your Virginia income tax return. The original donor may carry forward unused credits for 10 years. If you receive the credit from someone else, then the carry forward period is 11 years from the date it was originally issued. So this is a transferable credit. So sometimes you will see if you're preparing your client's 1040 and their Virginia return, they'll have a letter showing where they've transferred the credits. And so you want that in your file. It no longer needs to be attached to the return, I don't think, but you definitely want it in your file, and it has a specific kind of credit number allocated to it, I believe. Today's question, purchased or inherited 11 years? I think the 11 years is from the original date of the gift when the credit was issued. So it's not like not from purchase. If you purchase it from somebody, it goes back to whoever the original donor was, to the date they received their credit. So you have to watch that if you're buying tax credits, because you do want to know when they expire in case you aren't going to be able to use the full $20,000. They do have an expiration date, so they will discount the tax credits. Currently, those tax credits in Virginia are running about 89 cents on the dollar, 87. That's kind of where it's been for the last couple of years. If they are close to expiring, like expiring in 2022, you might get them for 60 or 65 cents or something like that. There'll be a heavy discount if somebody's trying to unload tax credits that they're sitting on. So any other questions on land preservation tax credits? Again, that's one you'll probably see more often in practice. All right, if no questions, then we'll move on to the business research, development, and investment credits. So the major business facility job credit, there's a major research and development credit, qualified equity and subordinated debt investments credit, the research and development tax credit, worker training tax credit. So the business facility job credit is basically for those operating a company in Virginia. They establish a new facility or expand the facility, and it's creating at least 51 new jobs in Virginia. That's kind of tier 1, or at least 26 new full-time jobs if located in designated enterprise zones or distressed areas identified by the Virginia Economic Development Authority. Retail businesses are not eligible for this credit, though. And the credit's $1,000 per new job created in excess of the qualifying threshold amount. Credit is earned over a 2-year period, and the employment level must be maintained for a minimum of 6 years. So, you can claim the credit for only 1 tier per facility. And that'll be filed on a Form 304 to claim that credit. So major research development credit. So we talked about the normal research and development credit. This is a little bit different. This taxpayers qualify for this if they had more than $5 million in qualified research and development expenses during the year. Qualified research and development expenses are defined under IRC 41, and only research conducted in Virginia are eligible for this credit. I've never run into this credit before, probably because of the $5 million. We're working, generally most of our new people, or at least those startups and stuff are well below that amount to start with. But the income tax credit is equal to 10% of the difference between this year's qualifying expenses and 50% of the average amount of the qualifying expenses for the previous 3 years. And if no qualifying expenses in at least one of the previous 3 years, the credit equals 5%. And yeah, you can't use same expenses to claim this credit if you're using them for any other credit. So that's going to apply across the board. All right, so again, don't see this one very often. Virginia cannot issue more than 24 million of those, so they have a large threshold. I'm not sure if they're meeting it. And again, there's an MRD form if your business does qualify for that to file it by September 1st. And this one gets certified by the tax credit unit. All right, so qualified equity and subordinated debt investments credit. Now this is a good one to kind of be aware of, especially if for new businesses looking for investors. You may qualify for this credit if you make a qualified investment in a qualified business. The investment should be in the form of equity, so purchasing the company's stock or a membership interest in a partnership or LLC. Or it can be subordinated debt, making it kind of like a loan to the business. So often you'll see this as like convertible debt when they set up these corporations for some of these research or biotech companies. Qualified investment is a cash investment in an entity neither you, your families, or an entity you're affiliated with receives compensation within a year. So this sometimes catches you because the owner is the one, you can't claim this credit in a business you own or operate, but it's getting outside investors coming in. So qualified business, this is a business that has annual gross revenues of no more than $3 million in its most recent fiscal year. It has its principal office or facility in Virginia, is engaged in business primarily in or does substantially all of its production in Virginia. It has not obtained more than $3 million in aggregate gross cash proceeds from the issuance of its equity or debt, not including bank loans. Is primarily engaged in a technology-related business, is normally where you see it, and businesses must apply to be qualified annually. They would complete this Form QBA and send it to Virginia by December 31st of the year to request qualification. So Brad mentioned yet that a lot of the local angel investors miss this credit. So it's really good to keep it in front of them. And I agree. I know some who will come in and you're filing their tax return and like, bad internet quality. Sorry, y'all. Yeah, as you said, a lot of times you'll miss this credit because again, you have to meet that December 31st date. But we filed 1 or 2 this year for some businesses, so you do see it periodically. So this is an income tax credit equal to 50% of the qualified investments you made to a qualified business during the year. And you must hold your equity investment at least 3 calendar years after the year you were granted the credit. If it's subordinated debt, the terms of the loan cannot require repayment of the principal for 3 years after the loan is issued. And then you can claim this credit up to $50,000 on your return, not to exceed your tax liability. So it's a pretty good credit if you have people putting in, $100,000 or more, into these new businesses. And the credits do carry forward for 15 years. So again, it's something that's out there that I do believe is often missed by businesses. So it is limited to how many they can issue as well. Let's see. Brad asked what happens if you don't hold it for 3 years. I think you'd have to pay it back like you would most of the other credits. Because again, you get it that first year, but I think it would have to be repaid. But I've never run into that before. How to claim it? Investors should complete Form EDC by April 1st. So again, there's a deadline for the investor as well as the company to make these applications. So definitely dates to watch. The research development tax credit. Well, are there any other questions on the qualified equity or subordinate debt before I move on? Okay. If not, the research and development tax credit for Virginia. I talked about kind of the federal and the payroll side. This one is if you qualify, if you had $5 million or less in qualified research development expenses during the year. This is the one we normally see versus the major R&D tax credit I previously mentioned. It's a refundable tax credit, and it's equal to 15% of the first $300,000 in qualified expenses, or 20% of the first $300,000 in qualified expenses if the research was conducted in conjunction with a Virginia public or private college or university. The credit is based on the amounts of expenses that exceed the Virginia base amount. Gets kind of complicated, but it's a certain criteria, but it's definitely nice because again, in those early years when you're doing a startup and you're paying all these expenses for research, you get this one back on Virginia. So it's kind of nice to offset your other expenses. Cannot use the same expenses to apply for any other Virginia credit. And again, we see this on, I have several C Corps that I do this with, but I also have an S Corp or 2 that I file this with as well. And Virginia has a limitation of 7.7 million in R&D credits per year. So these sometimes also get prorated and you don't get the full amount. Complete Form RDC, that one is due by September 1st. It used to be July 1st, and they'll send you a letter. They're just rolling in this year for anyone who we claimed it on the 2020 tax return. So we're going to be amending a few returns to claim their Virginia credit and their refund now. Tax credit unit must certify the credit, and yep, they're coming out now. So any questions on R&D?
Okay, I'm going to give Kendra a second to maybe take a breath.
Thank you.
have a glass of water or something. And I'm going to talk about the worker training tax credit. So this one, for purpose and qualifications, this is a credit on the cost of providing eligible training to qualified workers to be claimed against your income tax. This one can also be claimed against bank franchise tax and tax imposed on insurance companies and utilities. Or under the worker training tax credit, you can receive a credit on direct costs of providing manufacturing training or instruction to middle and high school students. And those will be claimed against the individual or corporate income taxes. So eligible training, this would be for the first piece there. This would be a training course offered as part of programs from specific providers. The Commonwealth eligible training provider list is out there in order to let you know whether or not those qualify. Or its instruction or training as part of an apprenticeship agreement approved by the Commissioner of Labor and Industry. For the manufacturing training or instruction to middle and high school students, this is going to be a program offered by the manufacturer. It must provide orientation, instruction, or training in the type of manufacturing that they're engaged in. It must be available to students grades 6 through 12 and coordinated with the local school district. It's held at the business's plant or facility or at a public middle or high school. And it must be certified by the Virginia Department of Education. So what is it? So the eligible worker training is 35% of all classroom training costs. This is going to be limited to $500 per qualified employee per year, or it's $1,000 for the employee if they're considered non-highly compensated. So that is someone whose income is below the Virginia median wage amount for the prior year. The manufacturing training for middle and high school students, that one is 35% of the direct costs associated with the training, and that's limited to $2,000 per year. And that one, like some of the other ones that Kendra was talking to, there is a statewide cap on that one, so that's $1 million statewide that's limited to. And to claim this credit, just like many of the others, you're going to complete your Schedule CR, 500 CR, or 502 ADG. And Kendra's break is over, and we're back to her after this next attendance code, which is housing. We're in the home stretch, guys, so stand up, do a jumping jack, or something in between if you need to. Okay, thank you, Kendra.
Mm-hmm. All right, so housing is code word 5. Moving on. So next, we're just going to briefly go through the housing and community development and rehabilitation tax credits. So there are communities of opportunity tax credit. There's the Enterprise Zone Act credit. This was actually replaced by a grant program in July 2005. So there's nothing really I'm going to go over with that, but if somebody did have this enterprise zone credit in the past, they continue to claim that until it's utilized in full. Historic rehabilitation credit, the livable home tax credit, and there's a Neighborhood Assistance Act credit, which you probably have seen on the 1040s filing periodically, and then a Virginia Housing Opportunity Credit. So this Community of Opportunity Tax Credit is for landlords with qualified housing units participating in the Housing Choice Voucher Program. So housing must be located in designated areas in Virginia, and the Virginia Department of Housing and Community Development administers this credit. It's an income tax credit equal to 10% of the annual market rent for the specific qualifying housing unit. And if it's qualified less than a year, the credit amount will be prorated. The credit cannot exceed the tax liability. So so then it can be carried forward for 5 years to use it. You cannot claim this credit and the rent reductions credit for the same housing unit in the same year. And they cannot issue more than 250,000 of credits in a year. So the department issues the applications need to be filed by March 1st. And if the total cap is not met, they'll issue it on a first come, first served basis after that. So these all get claimed on your individual returns, just as, the other ones. The historic rehabilitation credit, taxpayers rehabilitating certified historic structures and have certain eligible expenses may qualify. The structure can be one you're living in, or it could be income producing property. Qualified expenses must meet the Secretary of the Interior's standards for rehabilitation. And those expenses include work on the structure of the building, some site work to rehabilitate the structure, but it does not cover any kind of enlargements, additions, and things of that nature. So I'm talking about the Virginia. I didn't really talk about it on the federal side. There's also a federal rehab credit, and our real estate team has worked on these over the years. We've done quite a few of these. For both federal and Virginia. Virginia is a little easier to meet now than the federal ones are, but it's a tax credit that's equal to 25% of eligible expenses for the project. You can claim a credit of up to $5 million on your return, not to exceed the tax liability, and there's a carry forward for 10 years for the rehab credit. To qualify for the credit, the cost of the rehabilitation must be at least 50% of the assessed value of the structure prior to the rehabilitation, or 25% if you live in the structure. So again, you can do it from the personal side if it's your residence and you're improving this historic building, or we've had some businesses, even here on downtown, rehabilitating some of the businesses, and then their operations are conducted out of the property. Credit can be applied against the individual, fiduciary, or corporate income taxes, as well as it can offset bank, franchise, or insurance premiums, license taxes. So this one covers a little broader scale of what you can use it for. And DHR certifies the work for the credit and provides an application process on their website. So it's pretty intricate to go through and actually get the credits, working with the different departments. But once you get the credit, you'll claim it on your return just like any other tax credit. And if it comes through a partnership, some of these credits, I didn't mention it, like for the farm, winery, and vineyard credit, but some credits, when they come through a partnership or an S Corp, you have to file a PTE form within 30 days of the credit certification. And at least 90 days before you file the individual tax credit, because basically they're going to, if the corporation filed for it, they're passing it through, they need to get it registered in the system so that your tax return can be processed. And if it doesn't, it will hold it up until they can match them up. So any questions on the rehabilitation tax credits? All right, livable home tax credit. You may qualify to claim this credit if you purchase or build a new accessible residence. You retrofit an existing residence with accessibility features, and the Virginia Department of Housing and Community Development administers this credit. It is equal to $5,000 for the purchase of new accessible residence, or 50% of the cost of retrofitting an existing residence, not to exceed $5,000. Rental units are not eligible for this credit. The credit cannot be greater than your tax liability. So I've not seen one of these credits either. Guess a lot of my clients have a lot of rental units, so but it's nice to know it's out there. Credit can be claimed against individual corporate taxes, and this has a cap of $1 million for DHCD as well. So that needs to be filed by January 31st if you're eligible. Neighborhood Assistance Act credit. Now, this is, again, one we see periodically. Taxpayers who donate cash, marketable securities, or other items or services directly to an approved Neighborhood Assistance Program, NAP is what you usually hear it referred to, nonprofit organization. So the nonprofit organizations are the ones who are certified and receive these credits, and then your donations to that organization allows you to claim this credit. So individuals donating the cash or marketable securities qualify. Minimum donation must be at least $500 per taxable year. An individual is limited to a maximum donation value of $125,000 per year. Trusts donating cash, stock, merchandise, or real estate also qualify. Their minimum donation must be at least $616 per taxable year. Don't know how they came up with that number, but thought it was kind of interesting. Businesses donating cash, stock, merchandise qualify as well, even if they also are like renting, leasing the facility, or donating professional services or contracting services. So again, 616 is the minimum. Limited healthcare, pharmaceutical, mediation, physician specialists providing services for an approved NAP organization also qualify. And the purpose of the NAP is to encourage donations to approved nonprofit organizations to benefit low-income persons or eligible students with disabilities. So the credit's pretty generous. It's a tax credit of 65% of the donation's value. A NAP credit is non-refundable and non-transferable. So excess donor credits, if applicable, can be carried forward for 5 years. And the credit can be applied, again, to generally all taxes for individual, fiduciary, and corporate taxes. To apply, you contact the NAP nonprofit organization to which you'd like to make the donation, and you fill out the appropriate donor forms from them. The completed forms are then sent to the Department of Social Services or to the Department of Education to have your NAP tax credit certificate issued. These get mailed directly to the donor, and then you want this in your tax file to claim the tax credit when you get the donation. So you get the federal tax donation, and then you also get this Virginia tax credit. So it's kind of nice, best of both worlds. So if you have a way to make donations and do that, that's definitely a win-win. Not just for you, but for the organization too. All right, Virginia Housing Opportunity Credits. The purpose: you may qualify if you own or invested in a building used to provide low-income housing, and the building qualifies if it was put into service on or after January 1, 2021, and it meets the definition of low-income building provided in Section 42C of the IRC. So this is kind of a new Virginia credit that's out there. Tax credits equal to the amount of the federal low-income housing tax credit that the Virginia Housing allows for the project, and you don't need to reduce the amount of the credit used in the first year of the project. Virginia Housing administers the credit and can issue no more than $15 million in housing opportunity credits per year. And that credit would get picked up on your return. And I think, Christine, you're...
Yep, I'm going to jump back in for the port and international trade credits. So I realize that we're starting to run really short on time here, so I'm going to jump through this pretty quickly. We have the barge and rail usage, international trade facility, and port volume increase tax credits under this. These credits are taken on your applicable Virginia income tax return. The application, like many of these others, must be submitted and approved prior to claiming the credit. Shipments for the current and prior periods must be validated by the Virginia Port Authority. prior to filing these applications, and any allowable credit will be issued on June 30th. So to jump into details on these, I'm going to skip all of the actual dollar amounts here and let you just read those. But the barge and rail usage is for credit for transportation by barge and rail rather than motor vehicles, and that's obviously for Virginia-based travel. So Virginia highways, removing that off of that and doing it by barge or rail instead within Virginia. The International Trade Facility Tax Credit, that is a credit for creating new jobs or capital investment in an international trade facility. It's a result of moving 5% more cargo through a port facility in Virginia when compared to the prior tax year. And the port volume increase, that is a credit for taxpayers engaged in manufacturing or distribution of goods, agricultural entities, mineral and gas entities using public or private port facilities in Virginia. And that one is based on an increase of 5% more cargo volume through the facility as compared with the base tax year. I know I flew through those. Any question on those? No. Okay, so Virginia miscellaneous credits. Very, very briefly on these. The Coalfield Employment Enhancement Credit, that one is available to those who have an economic interest in, and I apologize, I'll butcher these, metallurgical coal mined in Virginia, or coal bed methane produced within Virginia. The Coal Employment and Production Incentive Tax Credit, that is available for an electricity generator who purchases Virginia mined coal to produce that power, or someone who has an economic interest in Virginia mined coal sold to an electricity generator. The Motion Picture Production Tax Credit. So that's available to motion picture production companies that are making movies or other productions here in Virginia. They must spend at least $250,000 in production costs within Virginia in order to be eligible for that credit. The Education Improvement Scholarships Tax Credit, that one is related to donated cash or marketable securities to an approved scholarship foundation. That's a 65% credit on your donation with a minimum of a $500 donation. So that one could potentially add up. However, the Virginia Department of Education must approve the donation before it is given to the foundation. So if that's something you may be interested in, make sure that you are following that through the Virginia Department of Education first. The Foreign Source Retirement Income Credit, that is related to tax that you've paid to a foreign country related to a pension or retirement from work that you've done within that foreign country in a prior year. Similar to the idea of the other states where you get the credit for the tax paid there. That would be for any retirement income earned while working overseas. And the Trust Beneficiary Accumulation Distribution Credit. This is for those, that income that is received as an accumulation distribution from a trust and is included as part of your Virginia income. The purpose of this one is to avoid double taxation on these distributions, since that tax has actually already been paid within the trust on these earnings. So that wraps up the Virginia miscellaneous credits, and I think we're back to Kendra to just run us through a few expired credits. Hence the code word expired. So that is the last code word for this session.
Yep.
Expired.
Expired, as I'm sure y'all are, of all these credits, exhausted. There are a lot of them out there. The expired credits I just kind of gave a list because again, I talked about a couple of them that were kind of expired or repealed and then made into new ones, but there's kind of the list of, the long-term care insurance credit no longer applies. Most of these have been expired for a while, but they were still out there. And if you have clients who had some of these credits, you can still use those credits. But that's kind of what, again, just what's expired there. And so of the 30, there was about 32 credits we kind of reviewed, Virginia credits specifically. And I think out of that, I just thought it was interesting. I went and kind of counted through the ones I've actually used, and only about a quarter of those, about 8 of the credits, is what what I have seen in my practice in 20 plus years of taxes. So again, a lot of these are very obscure. It was kind of interesting though to go through them in detail. Hopefully you learned something that maybe if you run across a client in a specific industry, you'd be able to help them take advantage of these credits, or even, just for your, self, if you're making donations and things to charities and things, especially at the end of the year now. It might be hard to get the NAP credits because they get taken really quick, but something to think about in the future too, out there for options for deductions. So I think we have, again, the last six code word was expired. So I think we went through them all. And are there any questions about anything that we covered, or we have like just a minute or two if there's any other questions on things that maybe we didn't cover that you had hoped we had? If not, I mean, we appreciate your attending, and make sure you complete your survey and get that out. Let's see. I'll check and make sure this was in there.
Kendra, do you want me to check since you're sharing them?
Yeah, if you don't mind, can you pull it up or
Yep.
figure out a way that I can, because they keep wanting to go through it all. Make sure we did include that. We did take them out and put them back in at the last minute, so I thought we had them all in there. But I don't have an updated copy with me.
I'm sorry, bear with me just a second. I'm pulling them up. Thank you, Jennifer. So there's,
she got 6. Okay, so should be.
Okay.
All right. Well, thank y'all. If you have any questions or run across credits that, you find interesting, let us know. Have a good afternoon. Enjoy your next session.